Hi guys, and welcome to another week ahead video. Now, our focus for this week's video will once again turn to the overall risk sentiment. We've seen some very interesting risk on and risk off flows over the last 2 weeks, and in this week's session we are bound to see some further flows with some upcoming events. We have Brexit events coming up, we have Fed events coming up, very important economic data, and then of course the elephant in the room, which is the ongoing concern with COVID-19. So join me now to the video to see exactly how we are preparing for this week's events and how we can hopefully trade them in this upcoming week as well. Now, after the mid-March market crash, we have seen markets make quite a remarkable recovery, and this was mostly fueled by the extraordinary fiscal as well as monetary policy stimulus efforts by central banks as well as governments around the world. Now, the hopes of the reflation narrative did see concerns about COVID-19 being pushed to the background as all the focus turned to the economic data and how quickly economies could reopen and bounce back. Now, the possibility of the dreaded second wave of the virus unfortunately did make landfall 2 weeks back, which gave risk assets a catalyst for a well-needed correction to the downside. Now, the correction was, however, kept in check at that time as the likelihood of renewed lockdown measures looked slim. However, that changed this week, obviously, when alarming increases in cases as well as hospitalizations led some key US states to actually halt the reopenings as well as reintroduce lockdown restrictions. Now, as a result, we did see another bout of risk-off flows, pushing risk assets lower. And even though the rise has been more prominent in the US, it hasn't been limited to the US, with new cases recorded in other places as well, like China, Australia, as well as Europe. Now, this does pose a threat to the current hopes of a meaningful economic recovery. And there has been some speculation that the ramp up in tests could be one of the reasons for the increase in cases, basically leading markets not to worry about it. However, looking at this graph above, we can see that the test adjusted data as well as increase in hospitalizations prove that more tests are not the only thing to blame for the rise in cases. And this poses issues for the recovery narrative, as Dangsbank rightly points out that if we see a fear of catching COVID-19 start to develop in the public, that can drastically affect public spending and obviously mean that the consumption rebound is going to be more gradual in the US than compared to other places in the world. So this brings us nicely to the week ahead, where we once again have a flurry of events that can cause some short-term bouts and risk flows that we can hopefully take some advantage of. Now, there's a couple of events we'll be paying attention to, all of which can create interesting risk flows from a day-to-day perspective. So definitely something you want to pay attention to for upcoming positions as well as current positions that you're holding in the market. The first one will be NFP Thursday. So that's Thursday, not Friday. The reason for the shift this week is due to the US bank holiday coming up on Friday in the run-up to the 4th of July weekend. Now, this one could be big in terms of risk. We had economists, traders, analysts all disappointed and basically caught off guard by the massive May NFP print that we had, which surpassed all expectations, and that was by a very big margin. And it does seem that another upside risk is possible and already being factored into the market this time around, with consensus expecting another 3 million print, but another wide range of expectations between 400k as the minimum and 9 million as the maximum. As always, we can look towards the preceding data like the ADP national employment as well as the ISM manufacturing employment sub-index for clues on where NFP might land. And as the recovery narrative is still very much alive, the data will be carefully watched for further signs of better than expected data. Second one to watch will be the Fed. We have the upcoming minutes of the FOMC meeting as well as the joint testimony by Fed Chair Powell as well as Treasury Secretary Mnuchin in front of the House. Now, the minutes will be very interesting. Some participants apparently felt uneasy after the previous FOMC meeting showed a more gradual and possibly more patient Fed, alluding to the various comments where Fed Chair Powell mentioned months ahead to mean that they are waiting for more info before making another move. Now, arguably, the more important thing to have taken from the meeting was not their current patience, but rather their willingness to keep everything they've already set in motion in place for as long as it takes. Thus, the minutes could either tilt markets into another bout of worry or could provide some further assurance that the Fed will come to the rescue if indeed they are required to do so. Now, in terms of the testimony, this would provide the perfect platform for the Fed and the Treasury to keep markets calm after the recent bout of risk-off flows. And a recent Financial Times article explained that the Fed has actually only used up about 4% of the total vowed liquidity measures. So there's still a lot of room left in the tank, so to speak. Now, third point to watch would be protectionism. Just when you thought things are starting to get a little bit boring, we get renewed protectionism fears with the US mulling tariffs against China, the UK, the EU, Germany, and of course tensions between China, which is an ongoing theme. Now, seeing that the US elections are but 5 months away, we should have actually seen these types of comments coming. To be honest, so whether all the threats actually lead to any substantial trade escalations or whether it will stay in the realm of political posturing will determine the market's ultimate reaction towards these types of measures. Fourth point to watch would be Europe. This week marks the start of another round of in-person Brexit talks as the two sides have vowed to step up negotiations. Now, over the weekend on Friday, we had German Chancellor Merkel firing a couple of warning shots to the UK by basically hardening their stance towards a deal and saying that the UK must live with the consequences of having weaker ties with the EU. Now, PM Johnson didn't spare any time to fire back on Saturday, saying that the UK is prepared to walk away without a deal, and that sets a rather apprehensive mood as talks resume on Monday. Also, German Chancellor Merkel and President Macron meet to discuss the EU Recovery Fund on Monday. Now, in the same interview where Chancellor Merkel slammed the UK, she vowed to spend most of her energy and time in the upcoming months to rather get the EU Recovery Fund across the table, which makes her meeting with President Macron all the more interesting for this upcoming week. Then, of course, the other focus point, the virus. The recent stock market wobbles in June was mainly associated with the rise in virus cases around the world, but more focused on the drastic rise in the US. Now, the recent resurgence has now forced some states to halt the reopenings as well as reintroduce lockdown measures. And if this trend continues, it risks destabilizing the recovery hopes and could end up having a far bigger impact on risk assets. So one area to focus on that would be in terms of the incoming numbers and following or potential lockdown restrictions, we'll be comparing any potential upcoming lockdown restrictions in terms of the US states to the actual GDP share contribution of those states on total US GDP. And this will provide a workable outlook for us on how severe the economic fallout might be as more and more states potentially move to reinstate lockdown measures. So then moving on to some possible sentiment shifts, starting with the hawkish side. Economic data, this one should be pretty straightforward. Expect much better than expected economic data to feed into the current recovery narrative, and that should be a positive input for risk assets across the board. And this will also be a welcome positive change from the virus-induced fears. Turning to stimulus, the market's negative reaction to the FOMC's prior meeting might be reversed if the minutes show that the bank's stance of doing whatever it takes have not changed. And the testimony by Powell and Mnuchin will also be a great opportunity to provide further assurance for the markets that extraordinary stimulus and easing measures are here to stay for quite some time. Turning to protectionism, there's a very distinguishable pattern of how trade talks have been developing over the last few years. We basically have one side providing market with angst by threatening economic pain through a variety of available mechanisms like tariffs, and then the same side produces relief for the markets through walking back those said economic pain by resolving the issue, so to speak. So let's just try and profit from these patterns and not get bogged down by the actual noise and by the actual political posturing. There is a discernible pattern after having the threats of potential tariffs come in play. If we now have the possible solution coming in, that should be a more positive input for risk assets. So definitely something to keep in mind in the week ahead. Also then turning to Europe, it's time for everybody's favorite game show, which is the Brexit deal or no deal. Now, the two sides have vowed to ramp up and gear up and intensify the talks, which probably just means that we can't or shouldn't expect any possible resolutions in the upcoming week until, of course, the very last minute, like we've seen these things play out so many times. But as talks are underway, as always, we do need to be prepared for the possible progress as it will affect risk flow. So definitely something to keep in mind. And the more interesting one, arguably, is the discussion between Chancellor Merkel and President Macron regarding the recovery fund. Any positive news of progress, maybe even news of getting some of the frugal fours on board, and that can be a real positive risk input as well as the euro. So definitely something to keep in mind. And then turning to lockdowns, if further lockdown restrictions can be avoided and reopenings can continue, that should give the market some sigh of relief this week. Turning to dovish shifts, again, economic data, expect much worse than expected data to basically feed into the current second wave fears, and that should be a negative input for risk. In terms of stimulus, the market's negative reaction to the FOMC's meeting might be exacerbated alongside virus fears if the FOMC minute meetings actually show the bank is taking a more patient stance than markets were hoping for. And of course, the testimony by Powell and Mnuchin could worsen matters if they appear less inclined to provide any further assurance. Then turning to protectionism again, for the biggest part of the last 3 years, the market has been inundated by political posturing as protectionist measures cause great uncertainty. And even if the recent numerous threats doesn't lead to actual action taken, a flurry of heated exchanges on trade relationships between nations will no doubt feed into the current virus fear narrative and could exacerbate risk off flows as well. Again, Europe, after the weekend's threats between German Chancellor Merkel as well as PM Johnson, the resumed Brexit talks on Monday might start off a little bit on the negative side and can drastically change the developments. And if we do see any major negative developments, that will be a negative input for risk as well. And then lockdowns, if further lockdown restrictions cannot be avoided, and not only in the US but around the globe, and reopenings are further halted, that should give markets more reasons to fear in the week ahead. Possible currencies to pair in the case of a sentiment shift. Now, the obvious focus this week will once again be on risk sentiment, which means that our highest probability setups will come from pairing high beta currencies against safe haven currencies. Now, as a reminder, high beta currencies are the Aussie, CAD, Kiwi, and safe havens are the Japanese yen, Swiss franc, and US dollar. So in case of a risk on sentiment, we can look for potential upside in the Aussie, Kiwi, CAD, and look for potential downside in the Japanese yen, Swiss franc, and US dollar. And of course, the exact opposite is true in a risk off environment. Also, as always, remember to keep the current sentiment in mind when making your decisions. Always look at things like oil prices as it can affect the CAD. Look at US-China developments as it can affect the Aussie. And also when it comes to the US dollar, the story for the US dollar is not only a risk tone one, but also a recovery one, right? So even though the dollar is a sought after haven during times of uncertainty like we have now, if we do see a much slower US recovery in terms of the economy compared to the rest of the world, that can soon start to see some of that safe haven appeal start to derail from the US dollar, and it's definitely something we just need to keep in mind as well. As always, don't trade risk sentiment trades in a vacuum. Always consider the underlying themes and sentiment drivers as well. Looking at possible economic data to trade into. Now, we do have NFP, we do have ADP, we do have jobless claims, etc. Not looking to trade into any of these because the main focus will be on the overall risk sentiment, which can, of course, change very quickly. Remember that these types of trades are like restaurant takeaways. The fresher, the better. So the fresher and more significant these shifts are, the better they are to trade. And in this type of environment, it's not always wise to aim for too ambitious targets. Make sure to look for those classic S1, R1 daily pivots, or your ADR highs and lows. Obviously incorporating your other technical indicators like support and resistance, psychological price levels as well for the highest probability entries and exits.